Guys, welcome to Forex Debunked. I'm Samuel Leach. I'm going to be covering some of these topics that you guys have brought to my attention and potentially bust the myth and tell you what is best for you as a novice and experienced trader. Today, we're going to be talking about the myths that you need high leverage in order to be a successful trader and make huge gains in the market. It's not true, and I'm going to tell you exactly why. Firstly, with risk management, you need to make sure that you're applying clear risk settings within your trading. If you're not, you're theoretically gambling. With over 70% of Forex traders losing, there is factual evidence produced by the SEC that shows that higher leverage equals more traders losing money. It's statistically proven that having a lower leverage trading account creates longevity for the trader and allows them to become profitable over the long term. So first of all, having low leverage forces you to apply risk management. So for someone like myself who uses 1 to 3 leverage, let's say on a $25,000 account, I can risk $250 per trade. Now theoretically, that is more than enough money if I'm targeting a 2 to 1, producing $500 per winning trade. By having low leverage, it reduces our exposure that we can physically have in the markets and therefore forcing that risk management. Protecting your downside is key when you start trading, both for a novice and experienced trader. Controlled exposure. Having controlled exposure forces you to use enhanced risk management. Having enhanced risk management means that you are controlling your maximum downside in your position. By having low leverage, there's only a maximum amount of money that you can risk on your account. This makes it absolutely crucial to your journey when you're starting trading. Because if you can control your downside, it means you protect your account first, which is one of the most important aspects of trading. Protect before gain. More thoughtful decision making. Having the ability to only place a few trades on a low leverage account makes you think more about the decision that you're making when you're placing your trade. This is very beneficial because it allows you to create a trading plan around your risk management, ensuring that you are following a set structure. The best part about this is it creates emotional stability, knowing that you don't have those highs and lows of emotions when you're in big wins and big losses, and how that can affect your decision that you're making when placing a trade. This benefits you because you'll have rational decision making. Having rational decision making allows you to stick to your trading plan, focus on the core concept of why you're entering, how you're going to manage it, and how you're going to exit. On the other hand, if you're going to have high leverage, you're going to have these emotional roller coasters of big wins, big losses. Emotional trading is going to take over, and you're going to be doing irrational actions such as getting in, getting out, closing your trade with the hopes that you're making big profits. And this isn't something that's going to survive for longevity. So forcing yourself with low leverage reinforces risk management. It creates emotional stability and rational decision making throughout your trading plan. We then have consistency. Having low leverage allows you to focus on your long-term goals rather than this whole get rich quick sort of play. It doesn't work in Forex, and with over 70% of retail traders losing, this is predominantly all down to leverage, and we're going to show you some facts and figures about leverage in a minute. Focusing on a long-term goal with low risk and good risk management allows you to perform longer, allowing you to have all of those learning curves throughout your trading journey without having losses that would potentially blow your account and you end your journey within the Forex markets. Having low leverage also allows you to be more flexible. It allows you to try different strategies in a low risk scenario, allowing you to work out what performs better for you as a trader down to your personality. Not one strategy is going to work for every individual without making their own personal adaptations on that. Now, if you're using ridiculous high leverage, which means huge amounts of risk of your account, potentially allowing you to be margin called, blowing your account and losing all of that money, beating the markets from an emotional standpoint and risk management standpoint all starts with leverage control. And then we've got enhanced learning for new traders. By creating longevity, it allows for that learning journey of whilst we're learning what works for us, how we relate to the markets. Do we trade around the news? Do we trade technically? Do we take into account fundamentals? What's the approach that we're taking? This is an enhanced learning friendly environment for traders. Starting off with low leverage is one of the most crucial things that you can do in your trading journey, because you're going to see exactly what works for you and what doesn't. And most importantly, it's not going to absolutely destroy you from a monetary perspective. There's two things in life when you talk about the markets. You're either going to learn through your losses or you're going to learn through training. Which one's it going to be? Either way, you're going to pay for those lessons. We then have revenge trading. This is when traders take a loss and then they double their risk, for example. They then lose that and then they double their risk. It's very much a gambler's mentality. And this creates losses spiraling out of control, where your emotions become erratic, you're making irrational decisions getting in, getting out of the markets, and it's very damaging for both your mental health, for your trading account balance, and for your progression at all in trading from an education standpoint. Having low leverage strictly in place physically does not allow you to do revenge trading, which a lot of people with high leverage have experienced, where they want to be more risky in one trade for a scenario over another one, and that dents their probability and how that pans out on their risk to reward, and all of these factors come into account. So starting with leverage is almost like having the stabilizers on your bike when you start. And don't forget, just start with low leverage, and as time goes on, you can always increase your leverage once you've shown you're profitable. If you cannot be profitable with low leverage, making at least 4% per month, for example, then there's no point increasing that leverage base and going all out to try to make it or break it. You may as well go to a casino. Let's talk about the facts and figures from a statistical point of view, not an opinion point of view. The SEC released a report around their findings of leverage, what happened when they forced a reduction in the use of leverage. Now, very interesting when you read this report, which is pinned in the description below. So the findings show that reduced leverage limits actually benefited the clients and traders. And the SEC report clearly states that the traders were 38% more profitable when their leverage was cut. So that just shows you that, statistically speaking, if we cut our leverage, it actually benefits us as a trader to become more profitable. Secondly, ASIC, the Australian Securities and Investment Commission, released another report. They compared Forex trading to gambling and basically said that you've got better chances at the casino as a retail investor. So when you think about this, it's completely true, because if people aren't applying leverage restrictions, if people aren't providing risk management, and people aren't using a clear and cut methodical approach to their trading, then they are gambling. So it's about getting yourself out of that gambler mentality and into a business mentality of how am I going to tackle these markets in an effective manner. And it all starts with leverage. So now what we're going to talk about is how leverage and risk of ruin come together. Now, understanding how much you could lose using a set strategy with a set win ratio is very important. So let's now explore that on a risk of ruin calculator to see exactly how much you could lose even if you follow your plan exactly to a T. So on my screen now, we've got what we call a risk of ruin calculator. Now, what this does is it allows us to mathematically calculate what is the probability that we're going to hit a set level of drawdown on our account. This is with risk management. So imagine using high leverage without risk management, how much worse this could potentially be. So when we break this down now, we're looking at a win rate of 40%. So if we've got a win rate of 40% and we're going to win roughly $500 per trade, and then we're going to lose potentially $250 per trade, we can see there we're risking 1% of a $25,000 account to gain 2% of a $25,000 account, we're going to be risking 1% per trade. And what is the probability that we could lose potentially 20% of our account, even with this mathematical criteria, knowing full well that we have got a win rate of 40% and we're going to win a 2-to-1. And over 1,000 trades, you can see that there is a 37.4% chance that we could hit a 20% drawdown. That is absolutely crazy. Now that's assuming that we have placed this over 1,000 trades. Let's see if we drop that to 100, what happens? Do you see what happens there? The risk of drawdown goes to only 1.6%. Because we're taking fewer trades, it's not allowing for probability to pan out. So what that means is that some people that risk potentially higher leverage will potentially get away with it initially, but over the longevity of their life of trading, they will experience high drawdown. So let's now prove that even further. So let's say that out of their monetary account of 25,000, that they're going to risk $1,000 a trade, yeah? So they're going to potentially lose $1,000 per trade, okay? And they're going to try to win $2,000 per trade. So they're going to be risking 4%. What is the chances that they're going to hit a 50% drawdown? So half of their account could be potentially gone. Now, let's just lower this. Let's look at over 10 trades to see how they would do. There's actually a 0% chance, okay, that they could lose 50% over 10 trades. Now, this is where the false belief comes into play that I'm good at this, I can achieve this, so on and so forth. Now let's increase that number of trades to 50. Now there's a 3.7% chance that these individuals could get there and a risk of ruin of 10%. Let's now put this over 100 trades. There's now 11.9% chance that they could hit a 50% drawdown. Let's look over 1,000 trades. There is an 82.9% chance that this strategy, if it was exactly down to the T, would have an 82.9% chance of experiencing 50% loss of their account and a 10.186% chance of ruin. Can you see how this can emotionally affect your trading? Let's see what the chances of just achieving a 30% drawdown. 100%. There is a 100% chance that they will experience a 30% loss level on their account. So now let's factor that into this scenario. Do you think that someone's emotional stability is still intact at 30% loss of their entire account? Or do you think they would start to second guess themselves in their decision criteria, in their reward to risk criteria, in their strategy criteria, or with the frequency that they're going to trade? So this is why utilizing the power of leverage, keeping your leverage low, keeping your risk controlled is actually the most efficient way of being profitable for the long term within Forex trading. I hope you've enjoyed this video, guys. Make sure you thumbs up and subscribe.